Good afternoon, and thank you for joining us today. My name is David Talbot. I'm Managing Director and Head of Research here at Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on uranium today. We are going to hear from UR Energy CEO John Cash. Now, UR Energy is a company that I covered from about 2008 to early 2021, so it's great to be working with you again, John.
Yeah, it's good to catch up with you again, Dave, and I'll be working with you again. We're excited about that, and good to be back.
Thank you. So now during today's webinar, John will provide an overview and outlook, and then he will take some questions. You can type your questions into the chat box at any time. We'll get to as many as we can. But before we kick things off, first we need to discuss the fine print. During this UR Energy webinar, forward-looking statements may be made, and I direct listeners to the company's forward-looking statements outlined on page 2 of the corporate presentation. That can be found on the company's website, ur-energy.com. For Red Cloud Securities, I'd highlight this webinar is for information purposes only. It should not be considered a solicitation or recommendation to buy or sell securities. We note this call does not consider the particular situation or needs of all investors, and participants should rely on their own investigation and seek their own professional advice before investing. So please see our most recent research located on the Red Cloud website for specific disclosures on UR Energy. So with that, John, I'm going to turn it over to you to talk about the company.
Yeah, you bet, Dave. And yeah, again, it's good to be back with you guys, and certainly a very exciting time in the uranium space. There's a lot going on with green energy, geopolitics, and finance, and I'll be touching on those things. And certainly at our flagship properties in Wyoming, we have a lot going on. So a lot to talk about, and I'll just jump right in. But we like to show a photograph of our operating Lost Creek mine. It's an in-situ mine. So the photograph here is of the ion exchange columns that are catching uranium. And then the drums on the right-hand panel, that is our first shipment of yellow cake that went out back in 2013. And as Dave commented, we do have a disclaimer here. I might make some forward-looking statements. We do suggest that you do your own analysis before investing. And also please review the risk statements that we make in the disclaimer as well. So we have 2 flagship properties that we very commonly talk about. We have a number of other exploration properties that are also out there in the background. But for the sake of time, we'll focus really just on Lost Creek and Shirley Basin. Lost Creek has been up and running for over 9 years now. And during that time, we've produced nearly 3 million pounds of U3O8. And back in 2017-18, the market was not that great. So we made the decision at that point to allow the head grade to decline. We slowed down and ultimately halted the construction of header houses and drilling. But back in late 2021, we recognized that the market was beginning to improve and that we had some good tailwinds, and we decided to go back and start drilling again and start constructing so that we could be ready to ramp up very quickly. And so those programs are ongoing, and I'll comment more about those toward the end. But Lost Creek has a great resource in the ground, nearly 12 million pounds of measured and indicated, plus an additional 6.6 million pounds of inferred resource. Lost Creek's got a very good reputation of being a low-cost producer. And so that $16.34 a pound there, I'll give you some more details on that further into the presentation. But we've been able to get back or down to that low on C1 cash cost. The all-in mine site cost is around $33, just over that. And if you want to take a look at the full economic analysis for both Lost Creek and Shirley Basin, we'd encourage you to go take a look at our annual report for this year that came out in March. And then we did an update in September. It has a full analysis of both Lost Creek and Shirley Basin. All the numbers, several hundred pages for you to go to sleep to at night. But we've got that great resource at Lost Creek. That provides us a 14-year mine life. And we believe that we can go out and explore and find more pounds because we have a lot of acreage in that area, about 35,000 acres that we can explore on. And every time we've gone out and explored, we've been successful at bringing in more pounds into those resource categories. The plant there at Lost Creek, the photograph in the top right, the well field has a licensed capacity of 1.2 million pounds. The processing plant has a capacity of 2.2 million pounds. The delta between the two was very intentional. It's because we wanted to bring in pounds from Shirley Basin or from a competitor and do the processing at Lost Creek. So that's licensed and built out capacity that's ready to go. And with that, I'll jump to Shirley Basin because we would like to take those pounds from Shirley Basin and move them over to Lost Creek for the latter stages of processing. So we'll take ion exchange resin from Shirley Basin, truck it to Lost Creek, and process it there. But Shirley Basin, we now have all three of the major permits and licenses we need to go into construction and operation. And when we build that plant out, the total capacity, if we build out a satellite, will be 1 million pounds, or I'm sorry, 1 million pounds of capacity. If we build out the full plant, it'll be 2 million pounds of capacity. And that'll take our total capacity up to 4.2 million. We have a great resource at Shirley, 8.8 million pounds of measured and indicated. There are no inferred resources. This ore body has been drilled out on very tight centers and is very well defined and understood. It also has very good head grade. And Shirley Basin is likely the first in situ mine for uranium in the world. We've got records going back to 1963 when the previous owner said, hey, let's do an experiment and see if we can recover by installing water wells and dissolving the ore body. And they were very successful at that. They actually recovered well over 1 million pounds simply as an experiment back in the very early 1960s. So we're very excited to bring in situ mining technology back to Shirley Basin. So looking at production going forward, Lost Creek, we have the ability to ramp it up in 6 months or less to a very meaningful production rate. Shirley Basin, because it needs to be built out, we believe we can build it out and ramp it up to meaningful production in about 18 months and at a cost of about $30 million. So within a year and a half, we can be upwards of pushing 2 million pounds a year of production. Looking more broadly at the company, we do have a good cash position right now. End of the last quarter, our report, we had a little over 37 million in unrestricted cash. Beyond that, we've got a very good inventory, 324,000 pounds ready to sell. That's worth about $16.5 million at today's spot price. We have bid a portion of that inventory into the U.S. DOE uranium reserve, and we should know by middle of December if we've prevailed on that. Earlier this year, over the summer, we did sign our first contract that we've had for a while with a major U.S. utility. It calls for deliveries over 6 years of 200,000 pounds per year. So I've used the term in situ a few times, and I suspect a lot of people on this call are familiar with in situ and they know what it is. But for those who aren't, I'd like to show a picture of our operating Lost Creek in situ mine. And what you see out there, those brown boxes, those are wellhead covers. We don't make an open pit. We don't do tunneling or moving rock. What we do is we install water wells and we inject water, baking soda, and oxygen and some CO2 into the formation that dissolves the ore body, and we simply pump it to surface. When we're done, we restore the groundwater back to its baseline conditions. We'll remove the wellheads you see here in the header houses, and we'll return it to unrestricted use. So within a few years of us leaving, you won't even be able to tell we were there. So switching gears a little bit, moving away from the company and looking at the broader nuclear investment thesis. Really 3 points I want to touch on. First is green energy. Nuclear is a great source of baseload nuclear or carbon-free power. A lot of people don't recognize that even in the U.S., even though we haven't had any new plants go online for quite some time, we still are getting about 20% of our electricity from nuclear power. And about half of our carbon-free electric comes from nuclear power. There are already over 400 reactors operating in the world. 60 more are in construction, and there are a whole lot more that are on order and being designed. The World Nuclear Association, the WNA, every 2 years they do a study and they try to project nuclear demand for fuel going forward. The report came out last year in September. Their base case, they projected 4.2% annual growth through 2040. And in the upper case, they project 7.9% annual growth. It's important to note the timing on that because that was before Russia invaded Ukraine. I suspect now that after the invasion, there are so many countries that are wanting to move away from Russian natural gas. I suspect that those numbers are remarkably higher, and we'll see the next time the report comes out. But nuclear power is not only important for electric generation, there's also a move afoot to move to hydrogen production here in the US as well as in Europe. A number of other industries are recognizing the importance of the carbon-free electric, especially the crypto miners and the EV market. It doesn't make sense to run those industries with fossil fuels that are emitting CO2. And also SMRs, small modular reactors, are becoming more and more popular around the world. They are already in operation in 3 countries, and there are 11 countries that are developing those. And actually not too far from here in Wyoming, Bill Gates's company, TerraPower, is in the process of licensing their molten salt reactor. And they have also identified 4 other sites in Wyoming and Utah that they plan to go to coal-fired plants that have been shut down or will be shut down soon, and replace the coal-fired portion with small modular reactors. So there's not much demand on fuel right now for small modulars, but within a few years, we are expecting that demand to begin to increase, and ultimately it could become quite significant. Around the world, the acceptance of nuclear is growing, again, largely because it's carbon-free. And I'm not going to read through the entire list here, but I will point out the very top bullet, and that's China. They have a goal to construct 150 reactors in 15 years. That's a massive build out, especially when you compare, understand that we only have a little over 400 right now. So that's going to put additional demand on uranium supplies going forth. But in Europe as well, South Korea, Japan, even Germany now, who's probably one of the most anti-nuclear countries in the world, they are keeping their reactors up and running. And just around the world, people are looking at building out. Even here in the U.S., we have 2 reactors being built right now by Southern Company. The first is slated to come online late this year. The second is slated to come on early next year. So there's construction, active construction right now in the U.S. And we're really beginning to see strong support in Congress for nuclear power. Back in 2020, very late in the Trump administration, the U.S. Uranium Reserve was established and funded at $75 million. And as I noted on the third slide, we have bid into that reserve, and we are expecting to hear more on that by the middle of December. But there are 2 other pieces of legislation that have been passed that are very important, not so much directly for the front end of the fuel cycle, but they are critical for the back end of the fuel cycle. And that's the Civil Nuclear Credit Program and the Inflation Reduction Act. Those pieces of legislation, they dedicate several $billion to extend the life of the existing fleet and to encourage nuclear generation going forward. And as far as pending legislation, looking forward, we've got a couple of great champions in our industry, one being a Democrat, Joe Manchin, and the other being a Republican, John Barrasso from here in Wyoming. Very good, strong advocates for us, and they are continually advocating for us in our industry. They are looking at potentially cutting off uranium supplies from Russia, and that is an ongoing discussion on Capitol Hill, and we'll see if anything comes to fruition there. But we're also getting strong support for nuclear energy from the White House and the Department of Energy, because they recognize the carbon-free attributes and the importance of that going forward. But as the world began to recognize the carbon-free attributes of nuclear, the financial players saw that as well, and they began to jump in. Hedge funds, ETFs were formed, even some of the mining companies began to buy resources. But the real game changer was July 18th of last year, when Sprott jumped in with their physical uranium trust. They use an ATM mechanism to raise funds on the market. Then they deploy that capital by buying physical pounds of uranium and holding that in the trust. It's a one-way trust. So they buy pounds, but they are not allowed to sell those pounds back into the market. So they're approaching 60 million pounds in that trust. When they're on the market, we feel their presence. They can put a lot of pressure, especially on the spot price, because they've mopped up a lot of that mobile inventory that historically was out there. Moving to geopolitics, we can't really have a discussion about uranium without talking about Russia and the invasion of Ukraine. because Russia is such a big refiner, not a miner, but a refiner of uranium. And globally, they supply about 43% of enrichment and 38% of conversion capacity. The Western world simply does not have a good way to replace that supply should it be cut off. And then if we shift gears and we looked at the very front end, the mining or the primary supply, about half of the world's supply comes out of Kazakhstan. And that's concerning because Russia exerts a lot of influence over Kazakhstan through politics, but also because Russia has part ownership in several of the big mines in Kazakhstan. So they have a lot of direct and indirect control over that supply. Also, Kazakhstan is beginning to have trouble shipping material out of the nation. They formerly sent everything through Russia into St. Petersburg and then into the Baltic. But now insurance carriers are saying we really don't want to cover that material. The risk of going through Russia is too high. They're concerned about sanctions, direct or indirect. So Kazakhstan now is having to go out and look for an alternate route to get uranium out of their country. And frankly, they don't have very many good options. And so that is presenting a real challenge to the supply chain for getting material out of Kazakhstan. When we look globally at who can replace Russia, who can replace Kazakhstan, it's not a very good picture. The supply chains are very restricted, not much capacity out there. If we look at some of the historic producers of uranium, let's take a look at Africa, for example. China has moved in there and acquired 2 of the big mines. So those pounds are more likely to be going to China instead of the Western world. If we look at Canada, MacArthur River and Cigar Lake, they've been offline. Cameco is bringing them back online. Those are fantastic mines, very good grade, and have been prolific producers in the past. However, they're not big enough to replace Kazakhstan. And so we still have a supply gap if Kazakhstan or Russia gets cut off. If you take a look at Australia, the story is not much better. There's some production there out of Olympic Dam and also 4 Mile. Also 1 or 2 companies that would like to get production up and running. But the ability to grow that capacity is fairly limited, and it will take time. So switching gears here to take a look at the U.S., we are now nearly 100% dependent on imports into the U.S. Not a situation we want to be in for energy security or for national security. And although we consume about 50 million pounds a year in the U.S., production in the U.S. has declined to its lowest level on record. It's effectively zero. We don't have enough mine production in the U.S. to operate even one of our 93 reactors. But that's where your energy and our Lost Creek and Shirley Basin projects come back into view here. Because Lost Creek is built out, it's ready to ramp up and can be ramped up very quickly to begin addressing that good, low-cost ore body. We've got 9 years of production under our belt now. Our average rate of recovery over that time period is about 90%. That's really setting the standard for the in-situ industry. And we've got a great area around Lost Creek that's identified in green on the map that we can move out and do exploration in with the opportunity to grow the resource base going forward. Early on, I said Lost Creek is a low-cost producer, and these numbers I'm providing in this table, these are real numbers. These are not model numbers. These are actual audited numbers that you can see in our financials from years past when we were in higher levels of production. But I'll call your attention to 2015. If you follow that column down to near the bottom, the average cash cost, $16.27 a pound. That's a great, good, low cost. All in that year, we were in the around $33 a pound, and with the corporate overhead and the all-in cost puts us into the 40s. So we believe we can compete with certainly any Western company that's out there, any publicly traded company. We think we're right in the mix and probably one of the lowest cost mining companies out there. So Lost Creek has demonstrated itself to be a real producer with real pounds. Taking another look at Shirley Basin, 8.8 million pounds of shallow drilled out high-grade deposit. That's why we made the acquisition of that deposit back in 2013. We're pretty picky when it comes to M&A, but this is one that we did pick up because we believe we can bring it into production at a very low cost. We've got all the mine permits in place. It's on mostly patented land, so our holding costs are really small. The roads are there, the power lines are there. Some of the buildings are there. We are ready to go and construct once we get those contracts in place that would incentivize us to go out and do that. So at Lost Creek, we do continue to construct and to drill. The objective there is to shorten the ramp-up period as much as we possibly can. We have all of the wells installed now and tested in Header House 2-4. They are ready to go. We are working on finishing up construction of Header House 2-4, and then we're going to be moving on to Header House 2-5 to continue to put in more houses so we can ramp up quickly. While the market has been down, we have been able to keep our key staff, so they are still out there, and we've got a tremendous number of people that have got a lot of years of practice putting uranium in the can, not just talking about it, but actually mining and putting it in the can. We are very aware of the supply chain issues, and we're ahead of that. We've been ordering well in advance. We especially have to watch out on motor control centers, transformers, and flow monitoring equipment. So we're ordering those in advance. But the nice thing about Lost Creek is we've got 13 header houses that if we need to move equipment from the old houses to the new houses and recycle, we've got the ability to do that. So we've been hiring additional staff as we move closer and closer to ramp up, and we've been having success with that. Switching gears a little bit to talk about ESG. And I'm not going to read through all the slide here in the interest of time, but I will point out that if you look at the resources at Lost Creek and Shirley Basin and what we calculate we will recover, compare the energy generation there to the same energy generation from coal-fired power, and we're going to offset more than 300 million metric tons of CO2. That's the equivalent of taking 67 million cars off the road for a year, and we're proud of that. And we'll be talking more and more about that as ESG becomes more and more important to the investment community. And we're also taking other steps to reduce our footprint. So our company is well known for innovation. We've had a number of successes in research and development over the years. The top 4 items there kind of enumerate those. But very recently, we've announced 2 additional research and development projects. I'm going to start with the last one, then I'll come back up to the middle one there. But we are working on advanced water treatment and filtration. Our goal there is to reduce the amount of water that we consume. So we want to be able to recycle more and more water and waste less and less. Water is precious in the West, and so we're very cognizant of that. It's also expensive to get rid of, and so we want to be as cost effective as we possibly can. We'll have more to report on that in the coming months. It's ongoing, and we'll look forward to reporting back to the public on that. But going to the middle of the slide, I would like to spend a little time on this. Earlier in the year, we announced that we had patented and were developing an injection well casing and installation method. And yesterday morning, we did a press release on that. If you haven't seen that, I would encourage you to go look at that on our website. But what we're finding in phase 1 testing, there will be 2 phases of testing, but at the conclusion of phase 1 testing, we have experienced a 75% reduction in drill rig time when we are installing injection wells. That's massive. That has tremendous influence on our cost of production. It also has a tremendous influence on ESG because it reduces emissions, it reduces noise, it reduces disturbance of soil as well. But when we look at the bottom line on economics, we're estimating that the cost savings is going to be about $2.50 to $3.50 per pound U3O8 produced. Keep in mind, historically and going forward, we believe that our C1 cash cost is going to be a little over $16 a pound. So if we can shave the $2.50 to $3.50 off, that is a big savings. And we'll apply that directly to the bottom line in any contracts we have going forward. We'll simply be more profitable. Looking forward into phase 2 testing, we will really be focusing on well development methods and flow rates. Because, yeah, it's fantastic if you can install a well cheaper, but if it doesn't flow well, then you've not gained anything. So we'll be looking at flow rates going forward and testing that in a more operational setting. We're also going to be modeling the design or the geometry of our well spacing. Typically in our industry, we use a 5-spot pattern. So the 5-spot term is, you look at the 5-spot on a die, on the corners of the die, you have injection wells, and in that center spot would be a production well. That geometry has been utilized because injection wells are expensive to install. But if we're able to do this much cheaper, which we believe we're moving in that direction, then you have to assess, okay, should we go to a 7-spot where you have 6 injectors and 1 producer? The advantage of that is you address the ore more quickly and more directly. You don't leave blind spots or areas that are not swept efficiently with the water. So we're working right now, moving toward doing a hydrologic model where we will weigh the economics of installing more wells against the efficiency of recovery. And as we get that completed, we'll come back to the public and do more reporting on that. Also, the new technology, again, if phase 2 works out, we would like to be able to go out and license our patented technology to other industries. We think it's got great application in monitor wells because they're so inexpensive to install, but it likely also has application in other in situ mining commodities. So salts, lithium, other commodities of that nature, copper, there could be some application here with a significant cost savings. So we'll look at licensing that going forward. So moving to the company's market position, fully diluted, we have 242 million shares out. I'll already mention that we've got 37.3 million in cash in the bank near the end of October. Market cap hovers right around 280 million. We've got a great inventory that we can convert into cash. It's worth about $16.5 million. And we are a very liquid story. And so on average, the last 30 days, we've been trading a little over 2 million shares. And so it's a great story there. We are listed on the Russell Index, and we've got fantastic analyst coverage in the US as well as Canada. So we've got a great story there, great cash position, very investable. So just a few takeaways headed out here, Dave, to hand back to you. Just mentioned the cash. We've got a good solid runway there with that cash and with the inventory that we can convert into cash. We've got the ability to ramp up between Lost Creek and Shirley Basin to get upwards to that 2 million pound a year run rate, and we can do it very quickly. And we've got great staff to do that. Our staff are experienced. As I mentioned before, most of our staff, they've been in the uranium recovery industry, and I'll emphasize uranium recovery. We don't just talk about it. We've been able to go out and do it successfully, and they've got decades of experience. We're going to continue to work toward ramping up. We do have that one really good contract in place. We do need 1 or 2 more contracts in place before we can justify that ramp up. And that's my #1 objective here in the coming weeks and months, is to round out our contract book, layer in those contracts so we can ramp up production at Lost Creek first, and ultimately at Shirley Basin as well. So I'll conclude with the slide showing contact information. If we run out of time today or you want to talk further about it, please feel free to shoot me an email or give me a call. Would love to talk about it some more. So with that, Dave, I'll give it back over to you.
Great. Thank you very much, John. Great presentation. So we're now going to kick off the Q&A portion of the webinar. A reminder to everybody watching, you can type your questions into the chat box at any time, and we'll get to as many as we can. So we already have a few questions here, John, but you know, the Lost Creek plant is obviously an ISR mine, and Shirley Basin will be too. Can you maybe, you know, touch on why ISR production is your method of choice? What are the benefits of this?
Yeah, you bet. So U.S. deposits commonly are fairly low grade. That's okay. It just means that hard rock technology probably is going to be too expensive for a lot of U.S. Deposits. Same is true of some Australian deposits as well. But the in-situ gives us an opportunity to have a very low capital expenditure up front to build out, but also the operational costs are very low compared to conventional mining. So it allows us here in the U.S. and for our deposits at Lost Creek and at Shirley Basin to chase those with a relatively small capital expenditure and with very low operating cost and get very good recovery rates with minimal disturbance to the surface. So great technology that we can apply and keep the cost low.
Right. And speaking of low cost, your existing Lost Creek ISR plant has a capacity of what, 2.2 million pounds, so
Right.
lots of room there. Has anybody reached out to you regarding, seeking toll milling services? The more material you've got running through the plant, the lower the fixed costs
Right.
can come in.
Yeah, economies of scale are critical in any mining venture, and that's true at Lost Creek as well. We want to get that production rate up as high as we can. That gets our cost of production as low as possible. But no, David, we really have not been approached by anybody. We do have a number of competitors in the region, though, that are drilling and exploring and maybe interested in development. It would make all the sense in the world for those pounds to come to Lost Creek for processing there, both in the Great Divide Basin, but also Shirley Basin, which is not that far away. And that's what we intend to do with Shirley Basin. We'll build it out as a small satellite and simply ship that resin over to Lost Creek for processing. That's going to save us a lot of capital at Shirley Basin.
Okay, you just sort of answered my next question, because it almost looked like you were looking at building an ISR facility there as well, increase production capacity to 4.2 million pounds. But
Yeah.
you're saying you'd rather use that satellite plant that instead of build a new
Yeah.
one.
So when we license Shirley Basin, we license for both a satellite and for a full-blown plant. So if economics change, there's more resource to address at Shirley Basin, we can build out a full plant. We don't need to go back to the regulators to do that. It's already approved. We just go out and we do it. But right now, our assessment is that Shirley Basin would be best as a satellite. But even going forward, we can change that decision once we build out a satellite. It would not be that challenging to build out the back end of the plant, the precipitation, the elution precipitation, and the drying as well. Myself and our CO, we're very familiar with how to do that. We've done it before several times. And so we can go build it out if we want to, if it becomes the desirable option going forward. But that would take us up to over a 4 million pound a year capacity.
Okay, great. And how far away is Shirley Basin from the Lost Creek plant at this point?
Yeah, just a little over 100 miles and good roads most of the way.
Yeah. Okay, that's not far at all. So now Shirley Basin is considered a pretty good deposit, well suited for ISR extraction. So what are some of the attributes you see from that project? Because I've been told, I think it was Steve and it might have been Jeff in the past that they might have worked on that first had they had it.
Yeah, it's such a shallow ore body. It's got enough water over it that we can keep the gases in solution. With in situ, you've got to have that head pressure, and Shirley Basin's got enough water on it for us to do that. But it's 350 feet down, and even in a portion of the ore body, it's shallower than that because the previous owner, they were doing pre-stripping, so they took off a lot of that overburden. It's leveled out now, it's flat, but it's even less than 350 feet to get to that ore. So the drilling cost is going to be very low there when we install wells, but also it's completely drilled out. We don't need to explore there or do delineation drilling. We've got all the data. In fact, we've already got the patterns planned for the entire mine. We've got the monitor well completely planned. It's all planned out. We're ready to go. So it offered a lot of cost advantages. And yeah, it's not the biggest deposit in the world, but we believe it's going to be a very low cost because of all of those attributes. It's got power lines to it. It's got roads. It's established. It's a brownfield site. And so there's not much capital expenditure to get it up and running.
Right. And just to clarify, the deposit is underwater and that is needed for ISR extraction.
Yep, absolutely.
Right. And Shirley came over from your strategic Pathfinder purchase.
Mm-hmm.
Are you still actively evaluating potential for other projects, other opportunities?
Yeah, always. We're always looking for M&A opportunities, and that's not unique to us. That's common throughout the mining industry. Those conversations are ongoing almost nonstop, it seems. We are a bit different than some of our competitors in our philosophy. We are a mining company, and that's what we want to be. And we've not made many acquisitions over the years. It's very limited, really, because we are only after the highest quality assets. We're only going to make acquisition of things that we believe we can put into production economically within the foreseeable future. We're not interested in buying blue sky projects that may be 30, 40, 50 years before they're mined. We want to do M&A make acquisition with companies and projects that we can mine. And that's where our interest lies.
Right. Okay. So Lost Creek, that mine has produced for what, 6 years now? Seems like longer, I think. I
Yeah,
can recall
about 9.
9. There we go. So it is longer, but it seems even longer than that. I recall the long permitting process you were heavily involved with. And right now you're still working on the shallower roll fronts, but you have a lot of resources available a little bit lower than that on the existing KM roll fronts now.
Right.
How is your permitting process going for those deposits?
Yeah, you bet. The permitting process has really kind of drug out. It's not a reflection on us or any issues. It's the state agency is really short on manpower, and but they are now done with the completeness review. They're done with the technical review. We're actually moving into final public notice, and that'll be literally within days. We're going to go to final public notice. So I think by very early next year, we'll have that one put to bed and be able to address both the HJ and the KM horizons. We don't talk about deeper horizons, but at Lost Creek, there is mineralization in the L and in the M and in the N. It just continues to go down. Not a lot of drilling into that, but there is a lot of opportunity to go out and do exploration. We know there are redox fronts there. And so I think there's going to be a story there in the future, but we're not ready to talk about that yet, but it's there.
Yeah. So how do you make that decision whether or not to step further away from the plant versus stay close to the plant and go deeper?
Oh, that's a good question. It boils down to economics and permitting. And so right now we've got the HJ permitted, so we'll continue to chase that to the ends of the property and even into LC East because that's permitted. And very shortly we'll have the KM. We'll look also at some shallower mineralization that we're well aware of, and we'll continue to look at deeper. But yeah, it boils down to economics. And really putting in that pipeline to extend that out is not that expensive. And so, piping it in on that map I showed, that 35,000 acres, it's relatively flat. We're not burdened by a lot of topography. And so, the pipelining is not that expensive and not much of a challenge. In fact, we've not had to put any booster stations in, and I doubt that we'll ever put any booster stations in on that property.
Right. Okay. Now, yesterday you guys announced results from an ongoing R&D project tackling injection well installation, equipments and methods. So why did you decide to tackle this issue to begin with, and what did you find?
Yeah, you bet. So in 2021, early on, we were looking at starting up the drilling program again. And Steve Hatton, our COO, was going out looking to buy casing. He found that you couldn't get it in the short term. Maybe you could get it in 6 months, maybe 8 months, and that was not acceptable. Ultimately, we got the casing we needed to continue our drilling program, but we decided then and there we're not going to be reliant on that. There's got to be a better way to do it. So we started looking for a better material. It didn't take us long to identify a material. Then the engineering started, and the engineering took quite some time. There are a lot of different facets you have to look at to make sure the casing can handle the stresses of installing to a well at 450 feet, 500, 600 feet deep. And so we took a lot of time there. We got through the engineering and said, hey, this looks really good. And we said, we need to patent this. This looks really promising. But that's how we got started down the track. Is necessity is the mother of invention, and the lack of casing really pushed us in that direction.
Okay, so essentially you were able to come up with less and cheaper material and quicker installation times as well.
Yeah, that's exactly right. The casing material that we're using, and we're being careful not to talk about the composition, it's protected by patent, but nonetheless, we're keeping it pretty close to the vest. But it's 85% less cost than the PVC. So we've got a good cost savings there. And in the drill rig time, usually for a well, from the very start to the very finish, drilling the hole all the way to the development of the well, you're looking at about 3.5 days of rig time. And what we found early on in our testing is we're only taking about 4, 5, 6 hours of rig time to install a well. And then we turn our guys onto it. Our guys work a whole lot cheaper than drill rigs. And so we turn our guys onto it to finish up the installation and development of the well. So we got a little ways to go on that yet, but the results from phase 1 are very, very encouraging. And we're stepping now into phase 2 to test the development and the well flow.
Okay, so how will this affect economics at the end of the day and environmental impacts? And is it going to change the way well fields are laid out? And can that itself have economic impacts?
Yeah, it will. So starting at the first of the questions, we're looking at between $2.50 and $3.50 a pound, $2.50 to $3.50 a pound. We're leaving a bit of a gap there. I've got a precise number based on phase 1, but we gave it a bit of a range because phase 2 may move that within the range, but we think we'll stay within the range. So that's a big savings when you're looking at a production cost, a C1 cash cost in the $16 range. If you can peel off $2 or $3, that's meaningful, and that's profit that you can take to the bank. But yeah, going forward on the ESG front, because you reduce the rig time by so much, it really reduces your need for drill rigs. It reduces your footprint out there, less noise, less air pollution, less particulate going into the air, way less traffic that can have an impact on wildlife. So from an ESG perspective, it's got a lot of potential. But going forward, if we can keep that cost of those wells really low, we're going to look at the geometry moving from a 5-spot to a 7-spot. And the goal there is to increase the sweep efficiency so that the ore is never very far away from an injection well. If you look at a 5-spot pattern, there are certain areas in there between the injectors where your sweep is really not very effective. Yes, it gets there, but it takes a lot of time and a lot of pore volumes. But by increasing that number of injection wells around the exterior of your producer, you can speed up the flow rate, mine much quicker. You can get your pore volumes a lot faster, and it improves the sweep efficiency. So we're looking at that right now. It's a fairly complicated math problem because you have to not only look at sweep efficiency, you have to weigh that against the cost and the size, the diameter of your pattern areas. So there's a lot of math that's going to go into it, and we'll weigh the economics against the efficiency of the recovery and decide if we want to go to a 7-spot or not.
Right. Okay. No, sounds interesting. So another ESG question here about your water filtration and or water treatment and filtration. Now, you want an additional 90% savings on wastewater generation. And, I guess typically the rule of thumb for ISR well fields is you need to extract a little bit more, volume of water than you eject back into the ground to ensure you've got that proper convection underground. Is your wastewater generation savings starting in the well field? Is that are you going to maybe pump less water out?
No, it won't start there. We are required by regulation and by permit, as I think most everybody in Wyoming and probably everybody in the state, we are required to maintain a certain percentage bleed. For Lost Creek, it's 0.5%. So if we are producing at a rate of 6,000 gallons a minute, that means our bleed rate is 30 gallons a minute. So already with our Class 5 system, we're taking that 30 gallons a minute, or that 0.5%. We are running it through ion exchange. We remove the uranium from it. Then we run it through an advanced reverse osmosis. And then we also have a radionuclide removal system to treat that. So we are actually already, and we've already announced this, we have already reduced our wastewater generation significantly by doing that. But we believe we've got room to improve further. And honestly, we'd love to get down to a wastewater flow rate of less than 5 GPM, even when we're in groundwater restoration, keeping it less than 20 in groundwater restoration. That really can help us with our cost of installing deep wells, and it's just the right thing to do. Water is very precious in the West, and we want to preserve that. The water that we are treating, we are putting that back into a shallow aquifer. It's literally drinking water. And so ranchers can use that in the future generations. So instead of wasting it in a deep well, we're putting it into a shallow aquifer for future use.
Okay, Great, thank you. So I guess let's move back from the operations a little bit here. You recently signed a contract with a senior nuclear utility in the U.S. You are a proven entity. What is the status of your contract book? Should we expect more contracts, and when, if
Yeah,
before you ramp up production?
that's my number one objective. I spend more time and concern with that than anything else. We are talking with utilities here in the U.S. and in Europe, trying to round out that contract book so we can justify the ramp up. So, I mean, I can't comment on any details on any discussions or negotiations, but they are ongoing. And one thing that's interesting that I would like to raise is right now the published price for spot on uranium is about 50, and for the long-term price it's 50. If you look a few years out, it gets north of 50, but that's the published price for the global price. It's very clear that Western utilities in the US and in Europe are willing to pay a little bit more for the security of Western supply, whether that be Canadian or whether that be US. They are reluctant to put all of their eggs in the basket anymore of Kazakhstan and Russia. So they are looking for that diversification. Unfortunately, those published prices don't really reflect that, but we are certainly seeing that there is a bifurcated market out there. And that's something I think that needs to be explored more by the trade press going forward.
Right. Okay. Who are your main shareholders right now, and have any insiders been buying over the last few months?
So our big shareholders, CQS, Azarius, BlackRock, Global X, those are all big shareholders. And I'd have to go look and see what our status is on insiders, on what their trading is. Don't have that at the tip of my tongue, but yeah, we've got some good, strong shareholders. We don't have anybody that's over 5%, so we don't have any insiders in that regard. And we're always looking for more shareholders with sticky fingers. We like those long-term holders. So if anybody's out there looking to invest in uranium, that's the kind of shareholder we're looking for.
Great, great. Now, what are your cash, debt, and uranium inventory levels right now? And might these higher interest rates impact your operations or financials coming up?
Yeah, you bet. So cash position end of last quarter, right around a little over 37 million. We've also got a good inventory position. It's worth about 16.5 million at today's spot price. That's 324,000 pounds of uranium in inventory. That's all in storage at ConverDyn, so it's ready to sell whenever we wish to pull the trigger. So we've got that cash and got that inventory. We do still have some debt with the state of Wyoming. Some of our listeners here will recall that to ramp up Lost Creek back in 2012, 13, in that time frame, we took down a loan with the state of Wyoming. They were looking to diversify the mining industry in the state of Wyoming, and so they gave us a loan at 5.75%. We're making payments on that. We still have a little less than 12 million that we owe on it, and we'll have that paid off no later than the end of October 2024. So we're closing in on that going forward. But yeah, inflation and interest rates, that's a concern. The economics that we put out in March of this year and we refined in September, it takes into account inflation up to those points, but we don't know what inflation is going to be going forward. It could have an impact, especially on the capital cost of building out Shirley, but I'm very thankful that Lost Creek is built out, so we don't have a capital expenditure there that could be impacted by inflation. But it is something we're keeping a very close eye on, but it is built into our economics through September of this year.
Okay. Yeah, getting towards the end here, so we'll just wrap it up. Maybe talk a little bit about government programs. And UR Energy was one of two companies that really sponsored that uranium Section 232 review a few years ago. And I don't think anybody realized how right you were when you proposed that the U.S. was way too dependent on foreign uranium, specifically Russian and Kazakh. But one outcome here, I guess, the U.S. uranium reserve buying up to 1 million pounds this year. You expect to be a seller, I'm assuming, and do you have an update for us on that?
Yeah, we hope to be a seller. Some of that inventory, the 324,000 pounds that we have, all of that is U.S. produced. Most of it we produced. We have bid a portion of that into the reserve. We won't know if we've prevailed on that bid until DOE gets back to us. And their latest deadline is December 15th. They've been a little slow, had a few delays, but we expect to hear back within a couple of weeks on whether or not we've prevailed. So that'll be helpful. It's helpful to the industry, and hopefully Congress will see fit to expand that program going forward. It would be good to have a good reserve for the utilities to be able to draw on if supplies from Kazakhstan or anywhere else get cut off because of geopolitics or transportation or any other issue. I mean, we do have a petroleum reserve. By all rights, we should have a uranium reserve as well that's effective.
Yeah, I guess the 1 million pounds is going to be helpful, but necessarily won't support too many mines,
right.
If it's spread around too much. Do you think that the Nuclear Fuels Working Group has paid enough attention to uranium mining, or could they have done other things as well?
I think the uranium reserve should have been much larger, and it should have been for a much longer period of time. Early on in the Nuclear Fuel Working Group, the suggestion was a 10-year program, $150 million a year. And really, to be effective at supporting the front end of the fuel cycle, the miners, that's really what's needed, a long-term investment. Just a one-time, one-year investment, that doesn't incentivize anyone to ramp up. We're not at Your Energy, we're not relying on the federal government. That's not a part of our business plan. We are looking at commercial terms. That's our objective, and that's why I'm focused on contracting with utilities. So anything we get from the government, that's icing on the cake, but really our focus is on long-term contracts with the utilities.
Perfect. Well, John, thank you very much for speaking to us today. It's been a great pleasure.
All right. Well, thank you. It's good to catch up with you again.
Okay, thank you everybody else for tuning in. A reminder, the Red Cloud Securities has another webinar coming up this Friday. I will sit down with Consolidated Uranium. So that's December 2nd at 11 a.m. Eastern. So just keep in mind that's a little bit of an earlier start time than usual. Remember, Friday at 11 o'clock in the morning Eastern. So have a good day, everyone. Thank you, John.